I always want a track record, successful track record of at least 5 to 10 years. What you want to see is that the return on invested capital is also, for example, over those period of 5 or 10 years is higher than the ones of its rivals. Because this indicates that the company is doing something unique and they have a moat.
So I first got a chance to chat with you back on Millennial Investing Podcast, episode 314, and I really, really enjoyed our chat. So when you told me that you had a book being released, I jumped at the opportunity to get you back on. So the book is called The Art of Quality Investing, and it covers several very, very important topics that are necessary for quality investors to follow in order to reap the rewards of owning high quality businesses. So let's kick it off by discussing the background for your book. What are the essential points you made in it, and who did you write it for?
Yeah, thank you, Kyle. First of all, I think it's a true opportunity to be here, and I think what you guys are doing at TIP is amazing. So I'm really grateful that I can at least hopefully provide a bit of value over the next few minutes with the podcast. So the book, The Art of Quality Investing, has been launched on the 15th of April. And basically, I felt like a lot has been written already about value investing, growth investing. Everyone knows the book of Phil Fisher, of Benjamin Graham, and so on. But not much, or at least not many books have been written about quality investing. So what we try to do with the book, because I work together with Le Creuset on this book, what we try to do with the book is provide the quality investing philosophy from A to Z. So basically provide an entire framework to invest in quality stocks. So we will talk about, obviously, to start with, what is quality investing? Well, how can you find these kind of companies? So using a checklist to find these companies. So qualitative criteria like looking at the moat or the competitive advantage, the skin in the game part or the incentives of management, and also the quantitative criteria like, yeah, you know them, Kyle, return on invested capital, earnings growth, the profitability, the free cash flow conversion, and so on. Obviously, well, we all know that quality is often recognized by the market. So the next question to solve then is, well, how can you look at valuation? Because the skill is to try to buy wonderful companies at a fair price, right? So how can you determine whether a stock is fairly valued, especially when it's a great business? And then last but not least, well, we'll show you how to build and maintain a quality portfolio. So really the goal here is to form a complete framework from A to Z about the quality investment philosophy.
Excellent. So you wrote that, quote, quality investing boils down to selecting companies in a way that only the best ones remain. Buy them at a fair valuation level, then wait and let compounding do its work, unquote. So you kind of already just discussed that, but I'm interested in knowing more about how you grade the quality of a business. Obviously, some businesses have, every single quality attribute that you could ask for, whereas some are maybe incomplete and don't quite fulfill your criteria. So obviously you're filtering out the ones that don't meet your criteria, but I am interested in knowing more about a watch list. Like, are you building a watch list of companies where maybe the quality isn't quite at the level that you want to see it at, but you're watching them to see how they execute in the future?
Fair question. So basically, the entire philosophy is to buy wonderful companies at a fair price, right? Like Buffett says. And this can be done in 3 steps. So the first one is wonderful companies, then led by excellent management, and then three, try to buy those wonderful companies led by excellent managers at a fair price. And the essence here, or the important thing here, I guess, is that only the very best is good enough for you as a quality investor. So I'm not sure. Do you have any idea, Kyle, how many listed stocks there are worldwide today?
I believe it's around 26,000.
Yeah, I actually thought, and maybe the listeners can confirm, but I thought it's more like 60,000 today. But the interesting thing here is that when you look at the criteria, well, there are only a few stocks that fill all criteria of the quality investor. So you are being very strict. And the philosophy in that case can be seen a bit like a funnel, right? So worldwide, there are around 60,000 stocks. So the first thing you are going to do is you only want to buy the great companies. So you can filter or screen for companies with a high return on invested capital, high profit margin, healthy balance sheet, low capital intensity, and so on. And when you do that, well, only 300 to 400 stocks remain. So you already excluded the majority of all listed companies. Then, next step, well, once again, the saying of Warren Buffett, always stay within your circle of competence. So the next thing I do is I go through the list of 300 to 400 companies and I exclude or delete all the companies where I don't understand the business model. So just based on the company description of 2 sentences, you can skip many of them right away. I also, and that's the third step, exclude all stocks within emerging markets and all cyclical stocks. Well, maybe you can ask yourself, why would you do that? Well, regarding emerging markets, I don't feel like these companies are within my circle of competence. The culture is really different in emerging markets. And that's why I prefer that when you want to exposure to emerging markets, to China and so on, well, I prefer to do it via companies in developed countries, like LVMH, for example, that will benefit from the emerging markets and the fact that they are becoming wealthier there. Also excluding cyclical industries. So think about the construction companies, companies that have a large exposure to certain commodities like nickel, like silver, gold miners, and so on, because you really want stable and robust increasing revenues and earnings. So when you do that, well, only around 150 companies remain. Next step, and we talked about it, wonderful companies, outstanding managers, fair valuation. Well, next step is the skin in the game part. When you filter down even more and you only take into account the companies with skin in the game, well, only 60 companies remain. So remember, there were 60,000 listed stocks. Now only 60 remain. So basically, only 0.1% of all companies remain. And then obviously, these are all very good businesses. Then the third step is to try to buy these at fair valuation levels. And I think that the key takeaway here probably is, well, the watch list only consists of already great businesses, right? Often those companies are very expensive, and the trick is to try to find those who are trading at the fair valuation levels. And maybe another takeaway here is, for me, and obviously there is no golden truth. Everyone can fill it in how they want themselves. But I will never include a company that is on the verge of becoming quality. So I will never try to invest in the next big thing, only in companies that have already won. Obviously, this also means that you will never have bought, for example, Amazon or Apple 20 years ago. But for me, that's no problem at all, because the key objective here is to do slightly above average for very long periods of time without making big mistakes.
So you made a really good distinction between quality investors and growth investors in your book. So growth investors search, like you just said, for basically winners at a very early stage, while quality investors are focused on companies that have already proven themselves to be winners and can hopefully prove themselves to be winners for many, many more years into the future. So I'm interested in just learning a little bit more about how much history or durability you're looking for in order to, qualify a business as a quality business.
Yeah, in general, I would say it's quite simple, right? The longer the track record, the better. I'm quite sure that you've read the latest shareholder letter of Terry Smith. And there he basically said that the average year of foundation of their companies at the year end was 1916. In other words, well, they have been in the business for over 100 years. And when a company has been in business for over 100 years, it's way more likely that they will still be in business in 100 years from now, compared to, for example, a promising technology company that just IPO'd and is on the verge of becoming profitable, right? For me personally, I always want a track record, a successful track record of at least 5 to 10 years. And you want also, what you want to see is that the return on invested capital is also, for example, over those periods of 5 or 10 years, is higher than the ones of its rivals, because this indicates that the company is doing something unique and they have a moat. So to give an example, we'll take MedPace, for example. MedPace has been founded in 1992 by August Schundler. Well, the company has been really successful since 1992, so a track record of over 30 years. The founder is still the CEO of the business. So in that case, well, you see that the track record is good. You see that Agos Strunle is an excellent capital allocator. So that's what you want to see. So also for me, I will, for example, never invest in IPOs. And also when you look at the research, when you look at academical studies, well, they prove that. So when you look at IPOs and take all the IPOs on average, well, you will see that after 5 years, in 60% of the cases, all IPOs are loss making. Um, a lot of people are investing in companies that just IPO'd or at the IPO themselves to find the next big thing. It sounds promising, it sounds exciting, but in essence, in practice, only 0.1% of all these companies have been very successful. Only 0.1% of these companies returned more than 3,000% since their IPO.
Yeah, it's a pretty alarming statistic about the IPO market. And it's, you look at the stats and the base rates, and it's pretty obvious that you should probably just skip it. So going back to quality investments, when you're looking at quality investments, like you kind of mentioned on your watch list, is that you're not necessarily looking for a business to change from low quality to high quality, but you are looking for valuation changes. And one of the biggest, I guess you could call it a drawback, but it's not really a drawback. It's just a feature of quality investing is that really high quality businesses rarely go on sale. So Chris Mayer actually had a really interesting solution that he takes for buying quality business I want to share with you. So quote, I used to pass on stocks sitting at their highs. I would try to wait for dips. I preferred to buy stocks at big discounts to their 52-week highs or stocks near their lows. Silly belief, and one that has cost me money over the years. When I finally bought Constellation Software, after years of watching it like a dummy, I paid something close to a 52-week high. My return on that purchase has been quite good now. One of the things my study of Hunter Beggars taught me, and this is intuitive anyway, is if you think about it, is that the best performing stocks spend most of their time at 52-week highs. And it makes sense. A stock that is a great performer over a long period of time, the exact kind of stock you want to own, is a stock that is putting in 52-week highs fairly regularly. A beautiful long-term chart that is up and to the right. How else could it be a great performer? Unquote. So with that said, I'm interested in learning a little bit more about your portfolio management. Do you prefer to have a cash position on hand to deploy into positions as just as time goes by, or are you usually fully invested with these high quality businesses and just kind of handling the volatility as it goes?
Yeah. So first of all, I want to say that I really love your reasoning as well as the one of Chris Mayer. So I completely agree with it, and same for me. So I really don't believe in using technical indicators to try and time the markets or to base my investment decisions on, basically. So what you try to do is just try to buy stocks when it makes sense, right? So just trying to buy wonderful companies at a fair price. And regular readers of compounding quality probably know that. But I always use two models, and it's one, the earnings growth model, and two, the reverse DCF. Maybe it will bring us a bit too far, but very shortly, well, with the earnings growth model, you can perfectly calculate how your expected return over the next few years. And you want this to be an attractive number. Well, for me, when it is larger than 10 or 12%, well, in that case, it makes sense to buy the company no matter what valuation the company is trading at right now. Obviously, valuation is a part of the earnings growth model, but okay. And then the reverse DCF, with the reverse DCF, well, you just look at the expected growth which is implied in the stock market, and then you compare it with your own estimates and whether the stock market is too optimistic or pessimistic in this case. Regarding timing the market and leaving cash, well, I'm really a big believer in that time in the market beats timing the market. Everyone probably knows these charts that if you miss the best 5 or 10 or 20 days, well, that your return increases or decreases dramatically, right? So nobody can predict what the market will do over next week, next month, or even next year. So I really prefer to stay invested in the market all the time. And what I do is all my investable assets right now are invested in the stock market. I leave 6 months of cash in a proxy of a savings account, basically. And then for the rest, I think the beautiful thing for a lot of people listening right now is most of us are still working, right? So this means that when you receive a certain income, a certain salary every month, well, yeah, you can use this to dollar cost average and add to your positions. So I think that's the beautiful thing. And also what Warren Buffett says, well, when you will be a net buyer of stocks over the next 10 years, 20 years, well, you should pray for declining stock prices because this allows you to buy the great businesses you already own at cheaper prices, or you can keep buying them. So that's the lovely thing. And also, when you look at the data once again, well, the S&P 500, for example, when your investment horizon is at least 10 years, well, in 94% of the chances you will make money. When your investment horizon is 20 years, well, you've made money all the time in history so far. So a very important one here is that the longer your investment horizon, the less the multiple you pay matters, and the more the underlying growth of the intrinsic value becomes important. And there's a quote of Terry Smith, and I'm not sure if you've heard him, Kyle, but basically what he said is, well, if you bought the S&P 500 at 5 times earnings in 1917, so that's the lowest valuation multiple the S&P has ever traded at, five times earnings in 1917, and you sold it in 1999 at 34 times earnings, well, do you have any idea how much your yearly return would be in that case, Kyle? So bought it in 1917, 5 times earnings, sold it in 1999 at 34 times earnings. So the correct answer there is 11.6%, which is an attractive yearly return here, right? And the point I want to make is, well, you bought it at the cheapest valuation level ever, and you sold it at the highest valuation level ever. And indeed, your return is attractive, 11.6% per year. And you 7x your money due to multiple expansion, right? But when you look at the components of this return, well, only 2.3% of the 11.6% is due to multiple expansion. So you 7x your money due to multiple expansion, but it's only a fraction of the total return of 11.6%. When the multiple expansion wouldn't have taken place, well, you still would have made 9.3% per year, which is actually quite good. So that's also, it aligns with the point you made, I guess. It aligns with the point Chris made. So there are a lot of great businesses in the market today which are trading at quite rich valuation levels. But if your horizon, if your investment horizon is long enough, well, in the end, the stock price will always follow the evolution of the intrinsic value. And that's why I prefer to not hold many cash in my portfolio.
Excellent. So you noted the positives of looking at secular growth when analyzing high quality businesses, which I really enjoyed. So I'm interested in just learning a little bit more from you. How are you best able to determine the difference between, secular growth versus short-term tailwinds? Because, coming out of COVID, there definitely were some businesses during COVID that were riding some very, very good tailwinds. And I think a lot of investors confused that with, happening for a long, long time period into the future.
Yeah, fair question. For me, that's an easy one, basically, because secular trends are very clear and they last for years and even decades. Secular trends in general will change the way our economy works. So that's something completely different compared to a short-term trend like what happened to cannabis, what happened to GameStop, and so on. So secular trends is due to changes in our society, and they last longer than an economic cycle. So an economic cycle usually lasts for around 8 years. So you have a bull cycle and you have a bear cycle. Well, when a trend will already took place for 10 years, for example, and where it's estimated that it will still last for 10 years, well, in that case, you have a secular trend. And for investors, and definitely for quality investors, well, a secular trend is really attractive. Why? Well, when you know that in the long term, stock prices will always follow the evolution of the intrinsic value of a share, and that the free cash flow per share growth is the most important thing for the intrinsic value. Well, in that case, I think that completely makes sense that companies that are active in an attractively growing end market, that it's way easier for them to grow their free cash flow at attractive rates, and thus their intrinsic value, and over time also their stock price. when we look at the current environment right now, well, what are some examples of secular trends? Think about digital payments, right? It's no secret. Everybody knows that, I guess. Well, Visa and MasterCard do excellent businesses. And basically, today it has become almost impossible for other companies to take away the leadership of Visa and MasterCard just because it would be so expensive. And sometimes you hear in the media, well, there's a new fintech company that will take away the market leadership of Visa and MasterCard. But what always happens in the end is that they end up working together with Visa and MasterCard just because they need them in order to grow and to improve their business. So digital payments is a clear secular trend. Premiumization also. So many people will also know, for example, that at Compound Quality I'm invested in LVMH, company like Hermes, and so on. Another example, well, urbanization. What kind of companies or which sectors will benefit from urbanization? Well, elevated companies, for example, a company like Kone, a company like Otis, that is very strong in the services of those elevators, very attractive business. Well, you have a pets, another example. Well, I have a dog, for example, and I can already tell you that, especially because of my girlfriend, well, the dog is treated like a full family member at our house. So she wants very good food. When something is wrong with the dog, well, we go to the veterinary, and it doesn't matter how much for example, for pets, I also have a dog at my home, and it's treated like a full family member. So she needs good food. When something happens to her, well, we will pay for the medication no matter what it costs. And that's also what you see in general. Well, the more and more people are having less children in general, and instead they are having more pets and they're treating them as full family members. So who's benefiting for that? A company like Zoetis, a company like Edex, and so on. Obesity is another example. Well, look at the companies like Novo Nordisk and Eli Lilly, for example. Well, both companies are definitely companies that you would have wanted to own over the past 10 years. And even since their IPO, they performed exceptionally well. And you can go on like that, right? There is also a trend like a healthy lifestyle. Think about Lululemon, cybersecurity. For me personally, I think Fortinet is the highest quality play within cybersecurity space. But small side note here, well, I don't own the company because I think it's too expensive. There is an aging population. Well, we'll benefit from that. Companies like Sonova, for example, who are active in hearing aids. So today, I think there are still plenty of attractive secular trends in the market. And as a quality investor, well, you love to own companies that are active within these trends.
So pricing power is a decisive competitive advantage that very few businesses possess. And you talked about it quite a bit in your book. So I'm interested in knowing if you can briefly describe both what pricing power is and also how you factor pricing power when evaluating a business.
So in general, I would say, well, I absolutely love companies with pricing power. So what is pricing power? Pricing power is basically the ability to raise prices annually without losing customers. And that's very attractive. Why? Well, pricing power is only possible when a company does something unique. So for example, when you have company A and company B, and they have identically the same products, and company A increases its prices and company B doesn't. Well, in that case, I think it's quite straightforward that everyone will go to company B. So you can only increase your prices when you do something unique or when your customers are very sticky. So, for example, for myself, I have an iPad, I have an iPhone, and I have a MacBook. Well, last time or last week, my MacBook crashed. Well, you need to look for a new laptop. Which one are you going to buy? Well, I bought a new MacBook. Why? Because it's way easier. Your phone, your iPad, and so on is immediately synced. The backup is there, so you buy the new MacBook and you're good to go. So that's something. Customer loyalty can also cause pricing power, by the way. And what's the most interesting part maybe is that pricing power is a source of growth, and it's a source of growth that doesn't need many investments, right? When you need a new factory and so on, well, you need a lot of capex, a lot of capital expenditures. But when you just can increase your prices every year, well, you increase your prices every year by 3-4%, for example. Well, in that case, your revenue increases by 3-4%, and your bottom line increases even more, hopefully, due to operating leverage. So that's something really attractive. Take, for example, well, most well-known example maybe See's Candies. So Buffett or Berkshire bought it in 1972. And since 1972, See's Candies has increased its prices every single year. So they have increased their prices for more than 50 years straight. And it taught Buffett, well, the power of pricing power, the power of great companies. And when he wouldn't have bought See's Candies, well, he probably wouldn't have bought great companies like Moody's, Apple, Coca-Cola, and so on later on. So in general, I would say pricing power is really attractive. The most preferred companies are still companies with plenty of reinvestment opportunities, but they are very rare in general. And what maybe to add here, well, what are some examples of companies with pricing power? Think about the credit rating agencies like S&P Global and Moody's. Well, they increase their prices every year by 3-4%. You have in the luxury space companies, once again, like Patek Philippe, Rolex, LVMH, and so on. And what's also interesting to see is when you look at the current portfolio of Warren Buffett, you will see that almost all those companies are active in an oligopoly or in a monopoly. And most companies within an oligopoly or monopoly also have pricing power. So when you look at the current portfolio of Buffett, but also all the positions he has held in the past, well, the majority of them has pricing power. And if even Warren Buffett thinks it's attractive, well, I think we should definitely keep an eye on it too.
Hey guys, it's Clay Fink here, host of We Study Billionaires. Today, I wanted to tell you about our show sponsor, Vacasa. The dream of owning a vacation home can be daunting. From finding the best guests, to the maintenance, to organizing the cleaners after every guest stay. With Vacasa, they make that dream into a reality. As a full-service vacation home management company with vacation homes in key destinations across the US, they know how to make owning a vacation home easy and profitable. On top of proactive property maintenance visits by professional local teams, a data-driven booking platform, and around-the-clock support, homeowners earn on average 20% more revenue from their vacation homes. Vacasa makes vacation home ownership easy. If you're looking to make more from your vacation homes by doing less, partner with Vacasa at vacasa.com. That's vacasa.com.
Absolutely. So you made a really good point about action bias, which is our tendency to take action, often without good reason. So this is one of the most prevalent biases that I've observed in the market and one of the most harmful to investors' potential returns. So obviously, you and I both spend a lot of time studying great long-term investors with incredible track records, as well as market psychology and history of markets. So we both probably have come to the same conclusion that, doing nothing is indeed where a lot of money is made. But for other investors listening to this show who maybe aren't obsessed about it like we are, how can they best educate themselves to understand the power of doing nothing and the downside of being too active?
Well, you know the saying that the best investor is a dead investor, right? And that's actually, or fortunately, that's true. So each year, for example, you have a study of JP Morgan and they look at the performance of different asset classes. And over the past 20 years, you see that the S&P 500 returned 9.5% per year, while the average investor only had a return of 3.6% per year. So that's really bad, right? That's really not good, especially because those people, those investors, they have been invested in the stock market. They have taken the risks of being invested in the stock market, but they didn't get the reward for that. So that's something to be really cautious of. Risk reward is very important in the investment field. And I think it was Paul Samuelson who said, well, good investing is very boring. Good investing is like watching paint dry. And if you want excitement, well, go to Las Vegas, go to the casinos. And in that case, you're sure that you will lose all your money, right? So I would say the most important thing here is, well, to really get out the noise. Don't focus on the quarterly results and focus on decades instead. And I think the best example of this, and I'm a huge fan, is Francois Rochaud. You also know them. Well, last week he published his latest annual shareholder letter, and each year he compares the stock price or the performance of his fund with the owner's earnings of the businesses. And the owner's earnings are simply calculated by doing the EPS or adding the EPS with the dividend yield. And what you see is that since 1996, well, his portfolio returns 2,887%, and the owner's earnings were equal to 2,859%. So in the very long term, well, stock prices follow the owner's earnings almost exactly. And the key reasoning here is that in the short term, so in 1 year, and in some cases even 2 years or 3 years, well, stock prices might differ from the owner's earnings, but in the long term, they always follow each other. And if the stock prices decline and the owner's earnings increase, well, you know that the company became more attractively valued and might be, well, an opportunity to add more to your position, right? So the essence here is, well, always focus on what matters in the big picture. And as you know, Kyle, well, since last summer I quit my job, I worked in the industry, and basically what we did, and especially during results season, is, well, you have those reports from JP Morgan, Morgan Stanley, Goldman Sachs, and so on. So what you did during results season is you were reading all those quarterly reports. And company X, well, the EPS was $2.20 and the consensus was $2 2021. So that's not good. And the stock price declines 4% and so on. But in the end, I think that's just noise. And today I'm working full time on compounding quality. And I don't read those quarterly reports from the broker or from the research houses anymore. And I think it's actually a good thing. Just reading the 10K, just reading the transcripts of the earnings calls, that's more than enough. And it helps you to focus on the big picture and don't get distracted when a certain company reports 2 cents below consensus or something like that. I think that's indeed true, and also know it or see it with some friends. Well, some people indeed they want excitement, but excitement is not a good thing on the stock market. So if you know from yourself that you really want some excitement, well, I would advise you to do it only with a very small fraction of your portfolio, because the essence of investing is really trying to do a bit above average for very long periods of time. And you can do that by investing in very boring, great companies.
So I want to discuss another bias that you discussed in your book, which was the neglect of probability. So this is the tendency to consider the magnitude of an event, but not its probability. So I'm interested in knowing, how do you think investors can combat this bias to ensure that they aren't neglecting probabilities in their investing process?
Yeah, so I think in general, investing, especially looking for the next big thing, it sounds really exciting, right? So for example, well, when you invested in Amazon at the IPO in 1997, well, when you did that for 10,000, today you would have more than 50 million. And I guess that sounds really appealing. Everyone wants to have a company like that in their portfolio. And you see a lot of articles also in the media, well, will this company be the next Amazon, and so on and so on. But what nobody could have imagined, I guess, for example, for Amazon, is that when they were at the IPO, it was just a loss-making online bookstore, right? Nobody could have predicted that they would have evolved to one of just the largest e-commerce company in the world. And to add to that, well, when you look at Amazon since 1997, there have been multiple times that the stock declined by 50%. And even one time the stock declined by more than 90%. And for me personally, when I'm honest to myself, well, when I would have bought Amazon in 1997, I definitely probably wouldn't have kept the company until today, because there is so much uncertainty. Also, the last decade, the stock increased so much. So you really needed to have a strong stomach to be still invested in Amazon today when you already bought it at the IPO. And I think that people who bought it at the IPO, well, only a fraction of them will still own the shares or still own all the shares. So, and still, many people try to find the next Amazon, right? But the chances you'll find one are less than 0.00001%. So when your investment philosophy, when your investment strategy consists of trying to find the next Amazon, well, it's very, very, very likely that it will be a disappointment. And I think that the best way to avoid things like that, and the best way to avoid black swan events, is to really invest in very boring companies and don't seek excitement. So invest in companies that have already won, companies with a very strong track record. And everyone knows a quote from Warren Buffett. Well, rule number one, don't lose money. And rule number two, never forget rule number one. That's exactly true. So we all know that when your investment loses 40% in value, well, you need to make almost 70% to recover from that. So that's something you want to avoid at all costs.
So moving on to the financing aspect of quality investing. So you made some really, really good points about how, if a quality investment wants to fundraise, they, some of them are going to have a lot of tangible assets. Some of them are going to have a lot of intangible assets. And, depending on their mix of those things, one company might be able to secure a higher degree of funding than another. So for people who don't understand the difference between tangible and intangible, do you mind just actually briefly covering what those are? And then as well, just briefly discuss why you think or where you think quality investors should give preference to between one or the other, or if they should give a preference at all.
It's an important question, Kyle. It's also one we talk quite a bit about in the book. So basically, for those who don't know the difference, well, tangible assets are physical assets. So they have a measurable value. You can touch them. Think about real estate, factories, inventory, and so on. And on the other side, you have intangible assets. So intangible assets are non-physical assets. So you can touch them. Think about IP, so intellectual property, brand recognition, well, patents, copyrights, and so on. What is a good example of a company that has a lot of intangible assets? Well, think about Coca-Cola, for example, right? Buffett said, well, if you gave me 100 billion and said, take away the market leadership of Coca-Cola, I would give it back to you and I'd say to you, well, it can be done. So they have a lot of very strong intangible assets. The brand name of Coca-Cola is very strong. Same goes for Constellation Software, for example. Well, their reputation is so good, their culture is so good that when you are in the VMS field, so the vertical market software, and you need to or you want to sell your business, well, Constellation Software, everyone knows that within the segment, that it's the place to grow. And what is the difference here is the thing that when you look at classical companies and industries, tangible assets were really important. Think about the 1970s, for example, right? You have those classical industries, factories producing goods, and so on. While nowadays, well, intangible assets are very important. And the fact that intangible assets are becoming more and more important, well, this has advantages, but it also has disadvantages. What is, for example, the disadvantage of tangible assets? Well, tangible assets can be copied, right? Let's go back to the example of the factory in the 1970s. Well, when you have enough capital, you can just copy or rebuild another factory and do exactly the same. And that's an advantage of intangibles because some intangibles are very hard to copy, right? Think about, once again, about the example of Coca-Cola or what other companies like Alphabet, Apple, and so on are doing. So in that case, increased intangible is an advantage, but it's also a disadvantage or a risk. Why? Because, well, intangible assets have no recoverable value. When you go into bankruptcy and you have a factory, well, and you have some inventory, you can still sell the factory, you can sell the inventories, and so on. But when most of your assets are intangible assets and you're going to bankruptcy, well, IP, well, it can become worthless in that case, right? So the consensus here, or the key takeaway, I guess, here, is that I think that's no problem at all, but intangible assets are becoming more important, especially for quality companies, especially for software companies. But it's really important that you look at the strength of those intangible assets. So, for example, for Coca-Cola, well, the strength of their brand is very strong, but another company where there's way more uncertainty, well, in that case, when there isn't a proven track record and it's only intangible assets, that's something to be a bit more worried about, I guess.
So take me through your process here for evaluating management. So in your book, you discuss things like compensation, incentives, and insider ownership. So I'm just looking, what specific numbers are you generally looking for in these metrics that help you determine whether you like a company's management or not?
Yeah, it was Charlie Munger who said, "Well, show me the incentive, and I'll show you the outcome." Right? And he also said, "Well, I've always thought that the incentives are very important, and I've always underestimated them, and I completely agree with them. So management is very important, and that's also why at Compound Equality, for example, well, 60 to 70% of the portfolio is invested in companies with skin in the game." So skin in the game is really important to me. Why? Well, you want the incentives of management to be aligned with the ones of you as a shareholder. And it has been proven that these kind of companies also perform better on the stock market. When you, for example, take the Credit Suisse Family 1000 study, well, they conclude family businesses outperform by 3.7% per year on average. And then you also have another study from the Harvard Business Review who basically conclude that founder-led businesses outperform by 3.9% per year on average. So preferably, I really want to invest in companies that are still led by their founder, and when the founder still has significant insider ownership, like Medpace we already briefly touched upon, or Kelly Partners Group. And when this isn't the case, well, I prefer the companies, the family businesses, or the companies with a high insider ownership. Well, think about Evolution B, Brown and Brown, and so on. So that's also what I do, and it's available on the website. Well, I made an investable universe with 100 quality stocks, but 100 quality stocks where all the companies within the list are quality and they have skin in the game. And the main reasoning there is that I guess when you just would, for example, create an equal weighted ETF of those 100 names, that you tend to do quite well on average in the long term. Hopefully, or that's the goal, already better than the S&P. And maybe I will add a little story here to make everything more clear. Well, I guess we will meet each other at the AGM of Berkshire in Omaha this year, Kyle. Well, last year I also went, and I live in Belgium. So when I went back, I needed to catch my flights. And it was from Omaha to Chicago, then from Chicago to London, and then London, Brussels. I was traveling alone, and Chicago is a really large airport. And I was feeling a bit lost there, and I didn't know where to go because you need to take the metro to go to another departure hall and so on. And when we took off in Omaha, I heard someone behind me say that he was also going to London. So I saw him in the airport in Chicago. I asked him, "Well, you also need to go to London, if I'm not mistaken. Well, do you know where we need to go, which metro we need to take, and so on?" So okay, we went together. He was really kind, and obviously we start to talk. And first thing you ask is, because everyone in Omaha that weekend is there for the Berkshire AGM. Well, what brought you, or what brings you to Omaha, to the Berkshire AGM? And his answer was, "Well, I come there every year. I've come, or I've went for several years now. And that's because I really love the philosophy of Warren Buffett and Berkshire Hathaway. And I want to have the same philosophy, or we have the same philosophy within our businesses." And as an investor, that's what starts to get you interested, right? So we started to talk even more. And then I asked him, "Well, which company do you work for?" And he told me, "Well, I work for Judges Scientific." And Judges Scientific is 100 bagger in the UK. And they can be seen a bit as a mini Danaher. So they are active in scientific instruments, and they acquire other companies within this niche with a decentralized business model. So really intrigued, really interested. Obviously, at 100 bagger, I've known it because it's a serial acquirer, excellent business, and so on. So next question I asked him is, "Which role do you play at the company?" And it was actually David Cicerel. So he's the founder and CEO of Judges Scientific. And he was really friendly, and he was quite surprised that I knew the company because it isn't that large. So we talked about the business for 1 hour, 2 hours. And obviously, there are two things clear. You have skin in the game because David is still running the business. And second part, well, it's an excellent business. It's a 100 bagger. So I had two main questions for him. Is first one, well, I think if I recall it correctly, I think David is 71 years old right now. Well, what will happen with the business after you decide to retire? Well, and his answer was very clear. Well, we have been working just like Berkshire on the company culture for very long periods of time. So after I retire, well, the culture will remain intact. And then the second question I had for him is, obviously, well, since 2004, Judges has been a 100 bagger. And over time, everyone or every company suffers from the law of large numbers. So when you look at the next 20 years, what do you think the business will do or be able to do over the next 2 decades? And he needed to laugh. He didn't want to answer the question immediately. And we moved the conversation to something else. But then after 30 minutes, he came back to me and he said, well, I think that Judges can still 20x its intrinsic value over the next 20 years. So that's something you love to see, right? And those are the stories of excellent owner operators in great businesses that we are looking for. And maybe the side note here, I really think that Judges is an amazing business. It's a company I would love to own, a company I would love to be associated with. But today I don't owe them, or I don't own them yet, because I think the valuation is a bit too high. But those are exactly the companies where you're looking for as a quality investor.
Moats are obviously a massive part of quality investing. Without a moat, a business simply can't protect its profits from being withered away by competitors. But, I think moats have different strengths at various times in a business's life cycle. So when you're analyzing a business, how are you analyzing the strength of each moat and whether or not, it's getting stronger or weaker? Obviously, a business like Amazon has, they have scale economies, they got network effects. So, are you looking at each specific moat? And yeah, just love to know more about how you're analyzing their moats at an individual basis.
Yeah, so for quality investors, it all starts with the moat, right? So we will never invest in a company that doesn't have a moat, or at least where you think that they don't have a moat. So moat is very important. And how are you going to quantify this, or how do I do it? Well, I want the gross margin to be larger than 40%. This is also an indication of pricing power. And you want the return on invested capital to be larger than 15%. So in general, there are 5 moat sources. So the first one is for the cost advantage. So being able to produce something cheaper than someone else. Think about IKEA, right? This is a moat source I prefer the least, because it's the weakest one, basically. And studies have also proven that when you look at all the moat sources, well, a moat source based on cost advantages, they don't outperform as much as the other moat sources. You have one based on intangible assets. Think about the Coca-Cola example. Switching costs, well, think about the MacBook example I gave you. I'll just buy the MacBook again because it's easier and the platform and everything is synced. 4 moat sources, economies of scale. So when you produce something more, that you benefits more from it, right? So they can produce it cheaper and so on. And then last but not least, well, network effects. This is the best moat source, the strongest moat source. And it means that the more people use a certain product or service, well, the more valuable it becomes. So probably everyone, for example, today will have already used a service of a meta platform. So Facebook, Messenger, WhatsApp, or Instagram. That's a very strong moat source. And what I think is really important to understand here is that a moat is never constant. So in other words, a company's moat is widening or shrinking every single day. And how can you look at this? How can you see that a moat is widening or shrinking? Well, when a company, and that's exactly what you want to see, when a company's gross margin as well as return on invested capital is increasing over the years, well, it's a very good indication that the company's moat is widening, and the other way around. And for quality investors, but maybe more broader for every investor in general, disruption is really your worst enemy. So when you invest in a quality stock and the market recognizes quality, so the valuation is often a bit more expensive, and the moat disappears, yeah, you will end up with very bad results. It's a two-edged sword. So the valuation comes down, and maybe the growth you thought the company would report, well, it stagnates or it even declines. So So that's something really bad. Now, how can you protect yourself against disruption as an investor? Well, a company should always keep innovating. So in the book, The Art of Quality Investing, we also gave two examples. Well, Netflix and Kodak. I think everyone knows both companies. Well, Kodak had really a strong mood 25 years ago. It was even mentioned the Kodak moment, so the perfect picture moment, right? But they didn't innovate. They didn't keep reinvesting in themselves, and they completely missed the boat of the digitalization of photography. So today, Kodak is only a fraction of itself. And compare that with Netflix, for example. Well, Netflix, in the early days when it was founded, it was just an email service for physical DVDs, right? So you could order a DVD at your house. And they evolved and they kept innovating and kept investing in R&D. And today it's the largest subscription revenue streaming platform in the world. So innovation is really crucial, and disruption is always your worst enemy. And you have other examples like Amazon we touched upon. So the evolution from an online bookstore to the largest e-commerce player in the world. Same for Microsoft. So Microsoft today trades at quite rich valuation levels. And in 2011, they only traded at around 11 times PE. What was the reason? Well, the consensus was that the growth phase from Microsoft was over. So all from the laptops from Microsoft and so on, they couldn't grow anymore from that. But then the cloud came, right? And it's the most important growth pillar for Microsoft right now. And as a matter or due to that, well, the valuation levels of Microsoft tripled again from 2011 compared to today's levels. So, and the cloud obviously is really important. So, longevity here is also crucial, I guess. So, the longer a company already has a moat, the better. And the longer the track record of the company and the longer the track record of management of continuously innovating, keep reinventing itself, the better, because that's really important for investors and as a company.
So you wrote about your preferred capital efficiency metric in your book, which was return on invested capital. And I share your sentiment that it's also my favorite metric to determine how efficient a business is at managing its invested capital. But I'm interested in knowing, can you compare and contrast returns on invested capital to returns on assets and return on equity, and also tell the audience why you think return on invested capital is such a powerful metric and has advantages over those two others that I mentioned?
It's a very good question, a very important one to understand also. So when you compare return on assets with return on equity and return on invested capital, I completely agree with you. Return on invested capital is by far the most preferred metric. And let's shortly explain why. So first of all, when you look at return on assets, this is a metric I really don't like to use. Why? Well, return on assets is calculated by dividing the net income by the total assets of the company. And actually, this is a wrong formula. So it's a mismatch. Why? Well, in the numerator, you use net income, right? And net income is something that is for the shareholders. It's the money for the shareholders, basically. But in the denominator, you use total assets. And total assets, well, they can be linked to the shareholders as well as the debt holders. So they're comparing something that's only for the shareholders in the numerator to something that is for the shareholders and debt holders in the denominator. And that's something that is just mathematically not correct. And to add to this, well, when you look at the total assets, in total assets, there are also certain things that aren't needed to run the business. Think about excess cash and goodwill. So in general, well, some people still use the metric, but I would advise everyone to not use the return on assets metric. So return on assets is a no-go for me. Then return on equity. Already more interesting, I guess. Return on equity can be calculated by doing the net income and dividing it by the equity. But it can be a good metric because you look at what's attributable to the shareholders, right? But it's very important to understand here that companies can lower their equity part by buying back shares or by leveraging their balance sheet. So as a matter of fact, they can increase their return on equity by taking more risk, by leveraging their balance sheet. And also the share buyback part, well, in extreme situations, you can even have a negative equity, and as a result, a negative return on equity. because the company bought back shares so heavily. Think about Starbucks, for example. Well, they have a negative equity due to the heavy share buybacks. And as a matter of fact, it can actually be a good thing, right? So return on equity, you can use it, but please be cautious with it. Don't use return on assets if you ask me. Most preferred metric is definitely the return on invested capital. And in the book, we talk about it. Well, make a distinction between two kinds of return on invested capital: the traditional variant and the operational return on invested capital. Well, the traditional return on invested capital is calculated by taking the NOPAT, net operating profit after tax, and dividing it by the invested capital. And you want this to be larger than 15%. And when this is the case, it's a great indication of the fact that the company has a moat and is great in capital allocation. And then you have also the operational return on invested capital. And this one is maybe a bit less well known, but it's really an interesting one, and it's a really important one, especially when you want to calculate the reinvestment rate of a company. Now, what's the formula for the operational return on invested capital? It's once again NOPAT divided by invested capital. But within the invested capital part, you exclude the goodwill and all the excess cash. And this is really interesting to calculate the reinvestment needs of a company. So when you want to calculate the reinvestment needs, well, you take the growth rate of a company and divide it by the operational return on invested capital. So to give you an example, well, when a company wants to grow by 10% this year and they have a return on invested capital or an operational return on invested capital of 50%, well, you take the growth rate of 10% and divide by the operational return on invested capital of 20%, and 10% divided by 20% is 50%. So in this case, you see that the company needs to reinvest 50% to grow at 10% per year. And it's also an interesting example here. The higher the operational return on invested capital, the less they need to reinvest. Let's take an extreme situation. The company wants the same 10% growth per year, but the return on invested capital is 100% right now. 10% divided by 100%. In that case, the company only needs to reinvest 10% in order to grow 10%. And they can use the remaining 90% of their free cash flow to distribute to shareholders via dividends, share buybacks, and so on. And this also shows, for example, why compounding machines or quality stocks that can reinvest all their free cash flow in the business are so rare. Just because the return on invested capital is often really high, and they just don't need a lot of capital in order to grow at attractive rates.
So one of the points that you made in your book that really resonated with me was how, if you have a high enough return on invested capital benchmark, you don't really have to worry about the weighted average cost of capital. So can you just briefly discuss what the weighted average cost of capital is and the relationship it has with return on invested capital?
Yeah, so it's the important thing to know here that growth only creates value when the return on invested capital is larger than the weighted average cost of capital, right? And it also means that when a company with a very low return on invested capital invests in the business, well, they actually destroy shareholder value. So they would be better off to just distribute to shareholders via dividends and share buybacks, and that the shareholders can invest it in other more attractive opportunities. So take, for example, Airbus and Boeing. Well, those companies are very capital intensive. They have a low return on invested capital. So it's really hard. It's very hard for them to create shareholder value. And compare this with a company like Visa, with a company like MasterCard. Well, Visa has a return on invested capital of a bit over 20%, MasterCard almost 40%. Well, we can all agree, or I hope that we can all agree, that the weighted average cost of capital will never exceed 20%, right? So when basically the weighted average cost of capital, it's just at which rates you need to return in order to break even on a certain investment. And as a matter of fact, for me, from my side, to keep it simple, I always just use a proxy of my required return as a proxy for the weighted average cost of capital, which is 10 to 12%. But when to come back to the Visa and MasterCard example, well, while MasterCard has a return on invested capital of 40%, You can basically just say that they can do any growth investment and it will always create value for them. And that's what's so attractive. Companies with a high return on invested capital and plenty of reinvestment opportunities, well, those are actually real compounding machines. So to take the formula, again, reinvestment rate is growth rate divided by return on invested capital. While if MasterCard wants to grow by 10% per year, they only need to reinvest 25% of their free cash flow to do that. And they can use the remaining 75% to do share buybacks, dividends, and so on. And that's actually what they do. And when you can find, as a quality investor, a great business with a high return on invested capital, with plenty of reinvestment opportunities, well, that's actually really interesting. That's the golden egg for investors. And so far, I only know two main companies, I guess, that can do that, that can reinvest almost all their free cash flow in organic rate, that can reinvest almost all their free cash flow in organic rate. Sorry, that can reinvest almost all their free cash flow in organic growth, and that those are Copart and Dino Polska.
So speaking of Dino Polska, I want to finish this conversation off by discussing the business, as I know it's a newer position for you. But I want to get an overview of the business. Just simply put, why do you own it?
Short answer, well, I think that Dino Polska is a quality stock, right? And what I think is really attractive is that they can reinvest everything back in the business and organic growth. That's very rare, and that's exactly how compounding machines are created. So I think that Dino still has plenty of room for growth ahead. Now, what is Dino Polska? Dino Polska is basically a Polish company, and it's a Polish grocery company that are active in the rural areas of Poland. So they are focusing on standardized store designs, and they have fresh products. They have their own meat supplier. They have their own distribution centers, and so on. So the company, if you ask me, definitely has a moat. Why? Well, they are the number one store in Poland when you talk about price, convenience, and selection. And what also provides them with a competitive advantage is that they own almost all their own stores. And nobody else does that. And when you look at the math, when you look at the numbers, well, buying your own stores and buying the land, creating the stores, and so on, it only gives you a competitive advantage when your investment horizon is larger than 9 years. And that's also the case for Dina Polska, and it shows that management focus relentlessly on the long term. And the founder, Thomas Bernacki, well, he's still involved within the company. He still owns more than 50% of the business, and he's really well known for being a penny pincher. So looking for the cheapest garbage bins to spare or to save a few dollars every year in every store. Well, that's what he's known for. So it reminds you a bit of reminds me at least a bit about Mark Leonard. So being very secretive, focusing relentlessly on the business, and that's exactly what you want to see. So I guess it's a quality business. The fundamentals look really great, and the most effective thing for me is that they can still reinvest almost everything in organic growth at a high return on invested capital.
Yep, I agree with your sentiment. So one thing that's been interesting about Dino Polska just over the last year is that it's been an incredibly volatile stock to own. So, for short-term investors, probably not a good fit, but for long-term investors like yourself and myself, and probably a lot of listeners of this podcast, it's really good because it just gives you opportunities to decrease your cost basis. So I'm interested in just knowing a little bit more about what you think specifically about the evaluation of Dino Polska. Can you kind of discuss what kind of growth you're expecting in the near future?
Yeah, sure. I think the future still looks bright for the company. So you know that, Kyle. So Dino basically started in the west of Poland, and they are gradually expanding to the east. And when you look at the numbers, I think that Dino can actually almost double its store count from today's levels. So this means that the number of stores are expected to grow from around 2,400 today to 5,300 in a few years from now. And what is interesting that during the latest earnings call, and let's be honest with each other, the latest numbers weren't that good. So numbers were a bit below estimates. There was some margin pressure and so on. And the reason there is that there was more competition, and obviously you have some inflation. But what was really interesting in the latest earnings call is that they said, okay, growth will accelerate again in 2024, and margins will also go up in the long term. And when you compare 2025 to 2024, growth will accelerate once again. So over the next 2 years, well, I think that the results the company will publish should be quite good. And they also said that after they matured in Poland, well, they will expand to neighboring countries like Czech Republic and so on. And what is really important in this investment case, in the investment case of Dino Polska, I guess, is that in practice, the fundamentals are way better than how they look like on paper. So when you look at Dino Polska today, well, they have 2,400 stores, but you know or you see that 40% of these stores are still less than 3 years old. And why is that so interesting? Well, because these stores haven't reached their full profitability yet. And when you look at the fundamentals, when Dino Polska opens a new store, after 1 year, it's still loss-making. After 2 years, well, the free cash flow margin is usually on average equal to 2%. And then after 3 years, well, it goes to the normal or long-term profitability of 8%, which is actually not bad for a retailer, by the way. So this means that all these stores, their margins, and it's 40% of their stores, are still lower than what they will be in 3 years from now. So right now, Dino Polska is still investing heavily in future growth. But once one day the growth will mature and the growth will stagnate, well, they need to reinvest less in organic growth. So their growth capex will go down, their free cash flow will go up, and the margins of the business will go up because all stores will reach their full profitability over time. I think what's also interesting, and it's the last thing I will add, is the valuation looks quite attractive. So when I run my own owner's earnings, when I run my own earnings growth model, well, the expected return is 11.7% per year. So in other words, I expect that shareholders will get 11.7% per year return in my model. And when you look at the reverse DCF, you see that currently the market expects Dino to grow its free cash flow by 7% per year over the next few years. And this in comparison with the guidance of management, in comparison with the guidance of the consensus of analysts, well, over the next 2 years, they think that the free cash flow will grow by 25%. So the market thinks Dino will grow its free cash flow by 7%. The consensus state that will grow by 25%. So there's a mismatch here, and it's why I think that Dino Polska is it's one, the quality business, and two, too cheap today, which is why I'm very happy to be a shareholder today.
So Compounding Quality, I want to thank you so much for joining me today. But before we say goodbye, I want to hand it off to you. Where can the audience connect with you and learn more about you and your service?
Yeah, sure. So obviously the book, The Art of Quality Investing, has just been published. It would be lovely to get some feedback on the book and to learn from each other. And for the rest, people can also find me via Twitter, obviously, Compounding Quality, or via the website, compoundingquality.net. And for the rest, Kyle, I want to sincerely thank you for the opportunity here today. I think you are doing an amazing job. We are both interested in quality stocks. So I'm happy to keep sharing ideas and keep in touch. Quality investing is all about investing in the best companies in the world. We already briefly touched it, but the essence is very simple, and it's based on the philosophy of Terry Smith and Warren Buffett. So it's 1, you buy wonderful companies, 2, led by outstanding managers, and 3, trading at fair valuation multiples.